Hello, and welcome to the 8th episode of the Market Pulse series. My name is Rufas Kamau, market analyst at FX Pesa. So we'll be focusing today on what happened over the year, try to gather some lessons on what happened. Then after these, we try to see what we expect to happen in the markets next year. So I would like to begin with our mic test. So if you can hear me clearly, and then type hi on the live comment section. And these will confirm that everything is working just fine. Hi, Francis. Thank you, and welcome to the session. So, hi, Akasi, and thank you. Welcome to the session. Thank you for taking your time to join in. So, I'll be starting right away. So, let's look at what's happening. DJ Fly, welcome to the session. I appreciate your time. So, let's get this started. So, the first thing I want us to focus on is how the markets has performed. Also, I want to see how the various asset classes have performed over the year. And once we grab these, then it will become easy to get an overview of how the year performed and how you could have positioned yourself. So I'll be starting with the performance of various metals. Metals are a major thing in trading. I know there's a lot of traders who are majorly focused on gold, but gold is not the only metal in the markets. So the year-to-date performance for most metals are as follows. One, if you look at nickel, I think it has been the best performing metal over the year, up 49.8% year to date. And this is basically since the 1st of January up to today. So besides these, the other metal that has performed positively is platinum, and this one is up 4.6%. So the rest of the major metals are mostly in the red. They have basically lost over the year. So first one, platinum down 2.3%, gold down 2.6%, lead down 6%. Also, if you look at palladium, 6.6%, zinc down 10.7%, aluminium 12.6%, copper 13.5%, and also tin 38.1% down. So whenever we look at these performances of various metals, there's quite a number of inferences you can make out of this. One is how you could have positioned a majority of your positions in order to have an overall winning probability. So, for instance, if you knew this would happen over the year, then it would make a lot of sense to make sure that most of your positions in nickel are on the buying side. On the other hand, if let's say you are trading tin, aluminium, zinc, palladium, gold, silver, then if most of your positions were on the short selling side, then you can have an advantage. So I know it's quite tough to predict what will happen next year, but then if you can do your analysis right and identify the overall direction of the market, then you have an advantage over the average trader who doesn't have an idea of where the market is headed. So I'm hoping that my voice is loud enough. So just kindly comment quickly on the live comment section. If it's loud enough, then we continue as scheduled. So one key thing to notice is that all these metals, they have major uses in other particular sectors. So they also have a direct influence on how stocks perform. So for instance, if you look at Coca-Cola, which is a big brand that we normally consume on each and every day, it basically deals with beverages, but also it has its inputs. So the Coca-Cola cans that we normally use majorly around the world are basically made of aluminium. So if aluminium has been going down, which is down 12.6%, then this is positive for the stock. It basically means that the company is buying its raw inputs at a much lower price, and this is a positive. It basically increases their profit margins, and in that case, you find that the company is performing well year to date. So, for instance, if we do a quick Google search, of Coca-Cola, and then we see how it has performed over the year. So just click year to date here, and you can see that the stock is up 7.15%. So one of the major contributors of the performance of this company, besides just selling beverages, is that the input for its raw materials have been going down, meaning that it has a higher profit margin. So that's one of the ways you can evaluate how a company is performing by basically looking at major inputs. And once you understand the major inputs and how they've been doing, then you can look at outlook of that particular stock. So when you look at the larger commodities, there's quite a number. So if you look at the livestock, the agriculture index, then you'll notice that it has done quite well over the year. It's up 17.9%, and this is quite good. Looking at livestock has done well, 8.4%. Energy, up 4.1%. Agriculture, 1.0%, whereas the precious metals are down, and also the industrial metals are also down. So one key thing to notice is that as a cost of our food kept going up for the entire year, then there were sectors that were benefiting as they were making record margins over the year that is 2022. So for instance, if you look at food prices in UK, they are up over 20%, and this is quite significant. It's affecting consumer budgets. But as we mentioned at the beginning of the year, there are those products that we basically described as consumer staples. These are products that people buy because they need them. They don't just buy. So even if the economy is bad, people will still buy these commodities. So this includes simple stuff such as food, milk, baby formula, and all that. So if you think along these lines and you look at these stocks that are providing products that people need, then you'd notice that they were quite resilient over this particular year, especially considering that the rate of inflation was very high for a majority of the global economies. So this is basically a sign that these sectors have been resilient, and it could extend over to next year. So there is a good chance that people will still be buying these products despite the prices flying high. So we know that this year has been full of an energy crisis. So natural gas has been one of the best performing assets. And now that we're entering winter, where consumption of natural gas for heating homes is higher, then we may expect this to continue rising. So for nickel, basically the second commodity, then we have gas, which is oil. Heating oil, we have the index here. Soybeans on the positive side, live cattle, corn, feeder cattle, lean hog, wheat, platinum, sugar, all doing well. And then on the negative side, you can see Brent crude oil. So crude oil was majorly bullish for the better part of the year before changing to the bearish side. So if you are long on crude oil at the beginning of the year, then you probably made some good returns. But since hitting a top in March, we have been seeing the bearish market happen. So same case for majority of these other commodities that are on the negative side for the year. So this includes cocoa, gold, silver, wheat, palladium, US crude oil, lead, unleaded gasoline, zinc, aluminium, copper, cotton, and coffee. So that's basically what has been happening with the majority of the commodities. So just to give you an indication of what happened, we just go through the trading application, look at some of these assets. So let's begin with gold. So gold has been quite on a bearish trend for a good period of time. So at the beginning of the year, I'll try to mark this period here. Gold opened somewhere around 1830, traded sideways for the better part of January. And then in February and March, there was a very strong bull run, pushing gold all the way up until we saw this high of 2069. So since then, you can see the bear market lasted quite a period. So the market just kept trending down and down up until we hit this particular bottom. And this was 2 months ago. So from then, we had what looks like a triple bottom before the trend reversed and gold started moving towards the upper side. So one of the key things to notice is that when markets were getting quantitative easing money, prices were going up. Then there was the fear resulting from the invasion of Ukraine. by Russia, which drove gold prices even higher. But then investors started pricing in the information, then the trend started moving towards the lower side. So in March, this is the period when the Central Bank of the US, which is basically the Fed, decided to start hiking interest rates. And this would basically pull liquidity out of the markets, eventually strengthening the dollar and weakening equities as well as other risk assets. So what we experienced after the beginning of the hike, the dollar started strengthening against all other assets, whereas the major assets that we normally invest in, equities, indices, ETFs, they were all going down. So since then, you can see the overall trend as it continued. And now the most recent movement towards the upper side is basically indicative of a change of trend, where in this case, investors are expecting gold to now start recovering. So as we head into next year, there's a good chance that gold will start to recover and start moving towards the upper side. So one of the reasons is that the Fed is looking to hit the peak of interest rate hikes. And once they hit the peak, then the other option is to start reducing interest rates. So global trade or the global economy is basically slowing down as a result of inflation. So nothing much is happening. Production is not moving upwards. It's actually contracting. And with contracting economies, in this case, we'll be expecting gold to serve as a safe haven. However, for the better part of the year, as you can see, though we were in a bear market, gold did not serve as an inflation hedge. It was continuously losing since it was being replaced by the US dollar. So as we proceed, remember, this is an interactive session. So if you have any questions arising from the presentation, then feel free to type those questions in the live comment section, and I'll be responding to those questions right away. So there's quite a number of things that happened in the political sector. One, I remember we had the US elections last year. So the inauguration was in January this year. So since then, the political economy in the US has been quite stable. So on the other hand, we had the midterm elections. I think this was last month. This was expected to destabilize the markets for a while, since people did not know whether the Republicans would have majority control of the Senate or whether they would have the minority. So the midterm elections have not been concluded yet. Yes, a majority of the seats have already been completed, but at the same time, there's quite a number of seats that are still in contention, so we don't have a definite majority to determine which particular party will have full control. So the idea is, if the Republicans have control of the Senate, then there's a good chance that the policies that are being driven forward by the US president might have a little bit of difficulty passing. But then if the Democrats win majority, then it will be easy to implement policies. So investors will have more trust in what the presidency says, as long as he has control of the Senate. So that's one key thing to be focused on. So we also have had quite a number of changes in the UK. I remember moving from Boris Johnson, then we had another prime minister lasting for 2 weeks. Then we have Rishi Sunak, and this has brought a lot of stuff happening in the UK and also volatility. So we'll be passing on that later in the presentation. So looking at equities, and this is majorly US equities, I'd like to mention that they have been on a bear market for a good period of time. And this bear market can be easily visualized from the FinViz website. So this is basically the S&P 500, or the 500 biggest companies in the US, and this is their performance since the beginning of the year. So as you can see, there's only one particular sector that has performed well, and this is the energy sector. So remember, last year, which is 2011, the best performing sector was the energy sector, and this year it's still the best performing sector yet. So we are still in an energy crisis, and one of the major causes is that there's a war in Ukraine, and this has disrupted the supply of oil from Russia. So there's been less oil in the markets, and at the same time, if you look at the OPEC countries, or basically the organization of petroleum exporting countries, then you realize that they've been cutting output, and this is to manipulate prices to the upper side. So with this in mind, then we know that there has been a spike in demand over the good year we have had, and this has basically driven oil prices higher. However, as you've seen, in the third and fourth quarter of this year, oil has been contracting, going down and down, and recently, as recent as last week, has erased all the gains that it had made over the year. So some of the best performing stocks include ExxonMobil, which is up 69%. We also have Chevron, which is up 47%. At the same time, there's one unique particular stock here, which is Occidental Petroleum Corporation, which is up 120%. So it's one of the stocks that have been backed by Warren Buffett. He has been building a strong position in this. So investors followed suit, and that demand has been pushing the stock higher. So ConocoPhillips up 63%, EOG Resources 47%, and some of the major highlights may include, in this case, we have the Hess Corporation, which is up 82%. Earlier in the year, I think last month it had hit 100% before raising gains. There's also another one, I think it's Marathon Oil Corporation, up 66.93%. Earlier in the year, it had actually hit over 100%. So this is one key sector to be focused on. I don't know whether the energy rally will continue, but whether it continues or not, it's important enough to look into it and see if there's a potential for a continuation in this particular trend. So the rest of the sectors in the S&P 500 have spent a majority of the time in the negative. So the one that have been worst hit has been the technology sector. So majority of the stocks in the tech sector have been in the negative for the better part of the year. So for Apple, down 20%, Microsoft 27%, Oracle 9%, Adobe 42%, Accenture 30%, Nvidia 45%, and so on. So as you can see, just a brief highlight, you can see almost 90% of these companies have been on the negative, with the exemption of technology solar. So for companies that have been dealing with solar products in the tech sector, these ones are in the positive. So if you look at Enphase Energy, it's up 73%. And this is basically indicative of the energy crisis. So for any company that has been producing and distributing energy, there is a good chance that they made some good cash over that period. So communication services, both are also in the negative side. So Google and Facebook down. Disney, this is an entertainment. Both of them have also been contracting. So a lot of people have been reducing their expenditure in some of these products that are deemed to be discretionary. So when the budgets are tight, inflation is running high, and you don't have sufficient money, then you can forego paying something like Disney and Netflix, then go for stuff that you need. And these would include things like food, housing, energy, insurance, and all that. So a lot of people have been cutting their subscriptions in these in order to boost their consumption in things that they need, or leaving the discretionary stuff on the side. So that has been one of the things that have been happening in the market. However, there are a few exemptions. So for instance, for telecommunication services, even if things are bad, you still need to communicate. So you'll probably keep subscribing to your data bundles, buying airtime and all that. So for companies like T-Mobile, they quite survived that particular period. Activision Blizzard had an acquisition early in the year. That's why it's up. So for that, healthcare is something that you need. So regardless of the political situation, the economic situation, you still need healthcare. So in this case, this has been one of the most resilient sectors. So for the better part of the year, it was on the negative side. However, in the last 2 quarters of the year, we have seen a very strong and dramatic recovery in this one. So Johnson & Johnson just turned positive at 3.57%. Eli Lilly up 34%. Merck is up 43%. AbbVie 22%. We have Bristol Myers 28%. Gilead Sciences 20%. Amgen up 27%, and so on. So clearly, you can see this was a no-brainer. So if you did your research, realize that people still spend on this stuff, then you made some good year investing in these particular stocks. So healthcare plans, this is very important. People make sure that they have healthcare plans at any given time. So things like United Health Group made some good returns. Elevance Health, CVS Health, you look at Cigna Corporation and all that. However, for medical devices, they were much on the losing side. Medical instruments and supplies still on the losing side. And at the same time, diagnostics research was also on the losing side. So for the financial sector, this was also one of the worst hit sectors in the market. So Visa just made a recovery the other day. For the better part of the year, it was on the losing side. MasterCard, same thing. American Express, PayPal, which is down massive 60.54%. We have Capital One Financial Corporation, Discover Financial Services, as well as Synchrony Financial, still on the losing side. So banks that are diversified, JP Morgan, Chase, Bank of America, Wells Fargo, and Citigroup also has spent the better part of the year on the negative side. So focusing on the stocks that have been resilient, one of the key sectors has been aerospace and defense. So we know that whenever there is a war, these companies get a lot of customers and they make some good revenue. So investors are making some diversified investments in these, ranging from Raytheon Technologies, Lockheed Martin, General Dynamics, we have the Boeing company, we have Northrop Grumman Corporation, and so on. So in this case, we are expecting this to do well. So besides being in an energy crisis, there is also the food crisis. Remember, Russia and Ukraine are major producers and distributors of food products to the rest of the world. So when they could not distribute to the West and to a majority of the countries in Europe, then other companies had to chip in. So American companies benefited from this, and these ranges from the ones involved in direct food production, also farm and heavy construction machinery. At the same time, there's agricultural inputs. So for John Deere, it's up 28.51%. We also have Caterpillar, which is up 10.76%. And we have Packer Incorporated, which is up 18.39%. So at the same time, if you look at the agricultural sector, this is the agricultural inputs, then you notice companies like Air Products and Chemicals, 3.72%. We also have, Corteva, 34%. We have the CF Industries up 42%. One of my favorites is the Mosaic company, which is up 20%. And also we have the FMC Corporation at 16.41%. So besides these, then there is the consumer staples or consumer cyclicals in this case. So they have been on the losing side: Amazon, Tesla, GM, General Motors, Nike, and so on. Home Depot, Lowe's Corporation all have been the negative side. So nothing to look at here. But then in the consumer defensive, these are companies that basically survive, see the products they provide, things that people need. So despite how the economic situation is, you still need to do a visit to Walmart. So the stock was quite resilient, despite being exposed to the great resignation that we experienced earlier this year. So a lot of Americans were quitting their jobs entirely, either to stay at home or to change jobs to go to a better paying jobs, or even to go to a better working environment. So for companies that had a lot of employees, they experienced a lot of challenges getting talent, and this was a big hit on their performance. So Coca-Cola up 7.31%, Pepsi 4.88%, Keurig Dr. Pepper, this is 2.93%, also Monster Beverage at 5%. Tobacco, it's something that you need, especially if you are addicted to tobacco. So for smokers, they're not going to stop smoking just because the economy is bad. So in this case, the demand is quite resilient. So if you look at Philip Morris, this is a company that the biggest tobacco company in the world. Their biggest brand is Marlboro. It's up 7.24%. And also, if you look at Altria Group, it's up to, it's down slightly, but 2.15%. So for packaging, doing well with General Mills leading at 29.5%. So this basically gives you an overview of what has been happening in stocks. So despite the S&P 500 being down overall, then there is unique sectors and industries that were quite resilient this year. So looking into next year, we'll be looking at the economic situation and what we are seeing in order to make decisions going forward. So one key thing to notice is that the central banks around the Eurozone are being quite aggressive in hiking interest rates to address the high inflation environment that they've been exposed to. So with the Eurozone, we have seen the UK facing an inflation rate of above 10%. The EU zone also basically suffering from inflation rate of 10%. And this is quite massive because it's affecting consumer budgets. And if inflation is that high, then people don't have sufficient money to buy these discretionary products, which is basically weakening the stocks. So investors are focused on these, and they're looking for areas that might be resilient, considering the high inflation environment. So one key thing to focus on is energy. We are seeing an energy crisis. Energy bills in the UK have moved up over 150% this year. And going forward into next year, we are not expecting Russia to resume providing oil to the Eurozone. So as long as we remain in this situation and there's no sufficient oil in the markets, then economic growth will require this oil and demand is expected to push prices higher. So besides this, there's the issue of the credit card debt in the US. So credit card debt has been quite a major thing. And from this particular chart, and I'm hoping everyone can see it, it's basically projecting how credit card debt has been performing. And this is from way back in 1999. So this one has been rising modestly all the way up to around 850, pulled back to around 670 before rising to above 900. So it pulled back during quarter 2 2020 through the end of 2021. But then this year, it has been massively moving upwards. So remember, this is quarter 3 2022, and from then, it has been moving even higher. So with credit card debt moving higher, it basically means that people have to take even more debt in order to continue their spending in the US. And if they hit their limit and they are not able to take any more debt, then it could take a hit on stocks. So the bottom is not in yet, so we might have to wait a little bit longer until we have a real bottom in stocks where the Fed policy will potentially have changed from hiking interest rates to now cutting interest rates. So let's see. So there's a good question from Apollo. What's your view on indices, DXY, if FOMC raises interest rates by 50 basis points? As per the market expectation, interest rates are too high with divergence with other central banks, yet stocks are bullish on DXY bearish. So I just want to confirm this, that you guys were able to see what I was discussing. Don't know if I was sharing the screen properly. And this is right from the stock performance in the FinViz website. I'll be sharing the link with you guys. So what's happening with WTI Brent? I'm not convinced about the recession sentiments since we still have an resource supply constraint. What's your view on the bottom? So I'll be checking on that too. So back to the charts. So let's begin with one clear thing. The S&P 500 has been on a bearish market since the beginning of the year. So this was the peak on 4th January 2022. Since then, market went down and then up, down, and then hit this particular high here. And this on 29th of March, went all the way back down and then hit the peak again here. And this was on 17th of August, pulled back down and then hit this high recently. And this was a week ago. So when the market hit this particular high, and this was on the 1st of December, we have seen the market continue to push back down. And this could mean that the market has bounced from this particular trend line and is now headed lower. So from the data that we saw last week, the non-farm payrolls, or basically US jobs, performing better than expected. So we saw a number that was quite impressive, 260K jobs last month, compared to an expectation of about 200K jobs. So with this happening in the US, we're expecting that the economy is strong and resilient. And this gives the Fed more room to make more rate hikes in order to push inflation to the right direction. So in the previous reading, the US inflation was at 7.7%, having peaked at around 9.1%. So we will be expecting this to continue going down. That is the equities, as long as the Fed remains aggressive in hiking interest rates. So an interest rate hike over 50 basis points is basically 0.5%. So we'll be moving from 4% to 4.5%. So this is still quite restrictive. It's making access to debt more expensive, and it's basically reducing the amount of money in the US economy. So with this happening, we expect the stocks to continue facing challenges, getting less investors, and the prices moving further downwards. So though the bearish trend is weakening, you can notice the weakness from the change in the lows here. So despite forming a lower low, it was not along the previous trend line, basically indicating that the bearish trend has weakened, and at some point it could be headed to an end. However, as per now, from the recent performance of the S&P 500, which is basically 5 straight days where the market was weakening, then there's a good chance you'll be seeing some other downside in the S&P 500. And this is not just in the S&P 500. If you look at other US equities, such as the Dow Jones, then you notice that this bearish trend was quite similar. So from the high at the beginning of the year, we had this particular trend line before it was broken. And on the lower side, we had this. And from here, you're able to identify that the trend was weakening because the next bottom didn't quite hit the lower trend line. So from the bullish momentum, remember the Dow Jones is more resilient in a high inflation environment as well as a recession compared to the S&P 500. So in this case, for the bull run, the market was able to break the upper trend line for the first time in a year and then move even higher, got to this particular high here, and then even broke this high for a while. That is for like 2 days before moving further back downwards. So it's the similar thing, the NASDAQ or the Tech 100. So if I was to zoom these, then this has been the worst hit. So after quite a number of years on the bullish run, this particular year has been majorly bearish. So if I was to craft, I'll just show you that was the high of the year, at the beginning of the year. So since then, we've been following this particular trend. And also on the lower side, I think it was along this path before the market changed the shape of the lows here, and they started moving to a sideline. So a very strong correlation between the S&P 500, the NASDAQ, and the Dow Jones. So notice that as long as we have this trend line for the NASDAQ, it has been more bearish. So whenever it moves up, it doesn't quite get to the trend line. So even from the most recent price action here, we had 5 straight days, the market moving downwards after getting to this resistance. The market didn't quite hit this particular trend line. So it's basically indicative of the NASDAQ as being the weakest index among the top 3 indices in the US. So as long as the Fed keeps tightening in order to push inflation towards the 2% target, then equities are expected to continue weakening towards the end of the year and perhaps into next year. So Bitcoin was majorly on bearish trend for the better part of the year. So I don't know if I can get this chart. However, for the last couple of months, and I'm talking about the last 6 months, Bitcoin has been basically trading in a range, moving sideways. So the prices that we saw in June, July, August, September, October, and November have been sideways, and also December seems to be sideways. Though there was a slight break last month, moving a little bit lower, but the overall sentiment is that this market is either going up or down, where the overall direction is this way. So it seems like a reasonable support level. However, if we could get another drop towards the lower side, then there's a good chance you'll start accumulating at much lower prices. So that's one thing to keep in mind. So as per currencies, I think the most interesting currency pair for the better part of the year has been the USD-JPY currency pair. And this is mainly as a result of the huge divergence between the Fed and the Bank of Japan. So the Fed has been hiking interest rates, basically moving from 0.25% in March to the current level of 4%. And in the next meeting next week, we expect the US rates to get 4.5%. However, for the last decade, actually two decades, Japan has been struggling with deflation, or basically negative inflation. And that has been a key challenge for the Japanese economy. Also, they had a change of government from Abe to the new guy. So the new prime minister, he basically continued the same policies of the previous government. So he maintained low interest rates, which are currently at negative 0.1%. So that has been a constant for the better part of the year, actually for the entire year. And also, they've been doing what we call yield curve control, which is basically another term for a fancy term for quantitative easing. So the Bank of Japan has been pumping more money into the economy to try to boost their economy towards the right direction or towards growth. So for this year, I'll just show you where the year started right here. You can see the movement of the USD JPY pair as a result of the huge divergence between the two central banks. So on one side, the market gained by about 32% before moving back down. And if I was to use Fibonacci, then you're able to visualize the change here. So after making this move, the market has pulled back about 50%. So from this high, the market pulled all the way back down. This was 23.6%, got to that 8.2%, and then eventually to 50%. So after it got to the 50% Fibo level, what we are experiencing right now is the market rebounding as people have more confidence that the Fed will continue hiking interest rates and strengthening the dollar further. So if you understood the divergence between the central banks, that is the Bank of Japan and the Federal Reserve Bank of the US, then you would have positioned yourself towards the bull side on a majority of the positions you take, moving upwards in this case. So the US dollar was not just strong against the Japanese yen, it was also strong against the euro, the pound, and a majority of the other currencies, including the Kenya shilling. So if you look at the performance of the US dollar, and this is against the euro, then you notice that it was quite a strong bearish momentum. So I just want to try and mark the high of the year. So this is DEC, and then this is January. So we started here on a high level. So remember, there was this bullish momentum as investors were taking their profits for the year, which led to the dollar gaining against, the euro gaining against the dollar. But since we got to this top, the rest of the story has been a very weak euro against the US dollar. So in this particular trend, there was also a divergence. So whereas the euro the Eurozone was basically trying to hike interest rates, it basically moved a very small percentage from 0.5% up to 2%. However, the Fed moved from 0.25% all the way up to 4%. So the Fed was more aggressive, so investors would favor the dollar compared to the euro. So as a result, we saw a continued move downwards. And for the first time in my trading career, I saw the euro trading below parity. And in this case, parity is the line that marks 1.00 here. So at one point, you would prefer to have dollars compared to euros. So if anyone offered you $1,000, and this was between these 2 months, in form of euros, $1,000 plus 1,000 euros, then you'd have gone for dollars because the euros are much weaker. However, since last month, you can see the strong bounce here, where the euro is now recovering against the dollar. One of the reasons this is happening is profit taking. So a lot of investors that were short for the better part of the year are taking their profits. And this is literally by buying back the instrument, and buying drives demand higher and pushes the price higher. So at the same time, there's quite a number of changes in policy. The euro or the ECB, European Central Bank, is looking to hike interest rates further, tighten policy in order to fight inflation, whereas the dollar has achieved significant moves against inflation. So the room for hiking interest rates is getting smaller and smaller. So investors are projecting that the US will hit peak rates at 5%. So as we get into next year, we'll be expecting the Eurozone to be doing more and more hikes, whereas the US will be slowing down their hikes, looking to, at some point, start cutting rates in late 2023, at the second half of the year. So in this case, we might be expecting the euro to start recovering. So one key thing to notice is that this is not the only year where the euro was losing against the dollar. So last year was also the same. So last year, from here, you can see that for a majority of the period, the euro was losing against the dollar. This year continued all the way down, and now we are seeing some strong recovery. So there's a good chance that this bull run will continue for a good period before we look at new changes in the fundamentals or in the central bank policies, that is between the ECB and the US Federal Reserve. So as for the UK, the pound was also facing something similar. So for the better part of the year, the pound was losing against the dollar. So I believe the year started here. So this is the beginning of the year. So since then, the pound was just losing along two trend lines. So the upper trend line, the lower trend line, just oscillating between the two. Got to a bottom here of 1.0325. So this is the lowest I've ever seen the pound trade against the US dollar. And since then, there was a strong recovery. People believed that this was an extremely cheap price to buy the pound. Since then, it has made some good move from this level here. So from this bottom, the pound is up by about this is 18,879 points, or basically 1,887 pips. So this is a rise of 18.28%, which is not quite common to happen in 2 months between two major currency pairs. So in this case, we expect the pound to be more resilient as the Bank of England continues being hawkish. So Bank of England is currently getting challenges in terms of energy, as well as a high inflation, which has broken the 10% level. So in this case, if they keep hiking interest rates, this will poor liquidity of the markets, make the pound more scarce. And in this case, we could see the pound continue to strengthen against the US dollar. So that's the expectation for me going forward into the next year. So for Australia, similar thing. So for the better part of the year, the Australian dollar was losing against the US dollar. However, recent events are indicating that it's now recovering. So now you're testing a major trend line here, which was slightly broken before the market pulled back. So in this case, I'm expecting the market to break this trend line, and we see the Australian dollar moving towards this previous high that we saw in August. So this is a high of about 0.71333. So with that in mind, I'll be looking to see if there's any questions that you guys have been raising, and then try to respond to those questions on the go. So indices, DXY, if FOMC raises interest rates by 50 basis points, I expect indices to drive back down. So what's happening with WTI Brent oil? So for Brent oil, there's quite a number of factors that are influencing oil. So one of the factors that is influencing the performance of oil is the major consumers, which is basically 3 countries. So we have China, we also have India, and also the Eurozone. So China is the biggest importer and consumer of oil, especially in its manufacturing. So this week, China basically lowered the COVID-19 restrictions. So whereas the rest of the world has been enjoying some good activity economically as a result of removing all COVID-19 restrictions, China has never officially recorded a win against COVID. So for the better part of the year, they have been facing out of COVID-19 restrictions. And with the rising cases, they're getting the reality that at some point they will have to contend or to live with the disease. So with that in mind, they are looking to lower all COVID-19 policies. They've been doing it bit by bit over the last 2 weeks. And going forward, we expect China to remove all those restrictions. So when this happens, then we expect the Chinese stocks to start airing, and at the same time to see the Chinese currency to start weakening. So what we are seeing in China is an ultra loose monetary policy, where for the better part of the year, interest rates have been going down, despite interest rates moving up for other countries. So in Kenya, they have moved from 7% to 8.75%. In other economies, it's also a similar case. Interest rates going up, but in China, they've been going down, while Japan, they have been steady at negative 0.1%. So if China keeps rates low and then continues with quantitative easing, then this would be a premium ground for stocks to rally and continue going up, whereas their currency could start weakening. And this was a similar case for the US dollar during the COVID period, especially in 2020. So in 2020, the US lowered interest rates to almost zero, around 0.25%. And also they engaged in quantitative easing, which basically created a very strong bull market that lasted 2020 and 2021. So in this case, if China does the same, then we'll be expecting a very strong bull run. So when it comes to oil, you look at the major consumers, they create demand. So when you follow the demand, then you're able to tell the direction of the price will take. So one key thing to notice is that the economies around the world are contracting. The US economy is very weak right now. It's not printing good numbers. So some time back earlier this year, we saw the US print 2 consecutive contracting quarters, which is basically the definition of a recession. Though it's being denied officially, at some point we'll be expecting the official the recession to be accepted officially. So the Eurozone is also in a recession, so global manufacturing and business activity is on a slowdown, and this basically affects the demand for oil, and at the same time, it has been pushing oil prices lower. So if you look at the oil prices, let's look at US oil. From the daily chart, you can see it's basically a bloodbath since hitting this particular high, and this was earlier in March. So a high of 126 with Brent hitting a high of $131. So at the beginning of the year, this is where the price was trading. So since then, you can see that the market was majorly bullish, then kept going up, got to this level, pulled back downwards, and then kept going down. So sometime back in March, when oil prices were extremely high at $126.7 per barrel, the new president, Biden, basically decided that he will be drawing more oil from its strategic reserves. So drawing this oil would supplement the lost supply from Russia, and it would increase the supply while the demand was slowing down. So this kept pressure on oil prices to keep moving downwards. And for the better part of the year, oil prices have been going down. And last week, they erased all the gains for the year. And now we are trading below the year open. So what we are seeing here is a very strong bearish trend in oil prices. And this continue for a while. So as long as the global demand continues weakening, then prices go down. And at the same time, if you look at supply, the OPEC countries are trying to boost oil prices. So what they're doing is cutting oil production. They have basically cut in the previous meeting by about 2% of global demand. So if OPEC countries keep cutting oil production and supply, then this could have an impact on oil prices and drive them up higher. So as much as we are looking at these oil prices as being strongly bearish, it's also important to notice that if supply continues getting weaker and weaker, then it could have pressure to push prices higher. So one of the key things I've been noticing, especially for trading today, is that we had a very strong bounce here, pushing prices higher, then another pullback. However, after this rejection, you can see the rejection candlestick, the green candlestick is around towards the lower side. Then there's a good chance that we might be ending the week moving towards the upper side. So there's a good chance that after getting to hit the stop losses around this area and grabbing this liquidity, then there's enough to push prices back up higher. So for the better part of the year, oil has been losing, and it's as a result of countries drawing from their strategic oil reserves in order to supplement supply and keep pressure on oil prices going down. So remember, the fight for majority of the central banks was against inflation. And this fight seems to be having an effect as inflation is starting to slow down for some of the economies, but for Europe, it's still quite a big challenge. However, for Canada, they have been getting some good results in terms of inflation peaking and starting to move down. Australia and New Zealand, they have also been experiencing the same, as well as the US. However, for Japan, Japan has been looking to get inflation. So now the inflation has moved up above 3%. And this basically raises the potential that they may start reducing the quantitative easing, and this will basically prop up the Japanese yen. So the Japanese yen has been the major loser for the better part of the year in the financial markets. Well, let's see how the currencies have performed. We just go to the FinViz website. In this case, we look at the menu right on top, get off the map, and then look at Forex. So I want us to focus on how this has performed over the year. So we go to performance, and then we change this to year to date. And now you can see the overall summary of what has been happening here in currencies. So with the dollar being the stable or the unit of measurement, then the Japanese yen has been the biggest loser against the dollar among the top 7 currencies. So Japan losing 15.69%, The pound 9.64%, the euro 7.4%, Australian dollar 7%, New Zealand dollar 6.97, Canadian dollar to 6.92, with the Swiss franc being the most resilient, down 2.71%. However, considering the pound here and the euro, and then looking at the charts, then it's easy to notice that these changes have only happened recently. So if you look at the euro here, then the losses have already been offset by these recent gains we have seen over the last 2 months. So if this had not happened, then the losses would have been much bigger. So same case applies to the pound. If we are measuring as at this moment, then the loss would have been bigger. But this most recent movement has basically made a good recovery for the pound. So the numbers don't look that bad. But to be honest, they are very close to what we are seeing here with the Japanese yen. So that's a good summary of what happened this year. And now we have an idea of where to look, and also grab some ideas of what stocks might be performing well going into next year. So remember, we are still in a high inflation environment. The inflation in the US is still quite high. So from the economic calendar here, I can show you a brief summary of the interest rates. So for the major central banks, I think the most aggressive is Canada, which hiked interest rates yesterday by 50 basis points to 4.25%. New Zealand 4.25%, and the US is looking to hike this to 4.5% next week. So Australia 3.1%, the UK 3%, Eurozone 2%, Swiss franc 0.5%. So remember, for a good number of years, Switzerland has maintained interest rates at a negative rate because their currencies are partly backed by gold. So usually it often has a very high demand. So for Japan, this has remained in the negative territory, basically making Japanese equities desirable, but then the Japanese currency undesirable. So that's it for today. Thank you guys for your time. Thank you for your participation. And I hope to see you on the next session. So if you have any question left, please type the question in the live comment section, and I'll be responding to that question on the go. All right, guys. So if there's no question, thank you. Thank you for your time. Hope to see you on the next one.